everyone and welcome to this new edition of Business Africa. I'm Ndea Yonka and this edition has the following headlines. Africa has the second largest number of cryptocurrency holders in the world. If digital currencies promise to improve financial inclusion, the implementation of the regulatory framework is an absolute must. The Democratic Republic of Congo wants to revise the 2008 mining agreement with China. This contract, considered unbalanced, involves the construction of infrastructure in exchange for the exploitation of cobalt and copper. And finally, in South Africa, economists believe that reports from foreign rating agencies do not reflect the true growth of the South African economy. 53 million is the number of Africans holding cryptocurrencies, according to a report published by AAA, a company that specializes in blockchain technology. Experts deplore a poorly regulated environment which weakens the cryptocurrency business in the African market.
The adoption of cryptocurrencies by the general public is growing, not only in developed countries, but also in developing economies. According to a report by US platform Chainalysis, Africa is home to the second largest number of cryptocurrency holders in the world, after Asia. Experts believe this is due to the fact that people in low-income countries make heavy use of digital assets to send and receive funds, as the cost of cryptocurrency transactions is lower. While the technological innovation behind digital currencies has the power to drive global financial and banking interconnectivity, there is a need to implement a regulatory framework to oversee the use of digital assets. Countries such as Ghana and South Africa are exploring the use of central bank digital currencies as a means of legalizing cryptocurrencies. However, there are some challenges that need to be considered. Access to digital infrastructure needs to be improved, and governments must develop the technical expertise to ensure data privacy.
Mamadou Kwijim Touré is our guest this week. He is the founder of Ubuntu Tribe, a cryptocurrency platform. Welcome to Business Africa. Is it necessary to create a central bank digital currency to regulate the circulation of cryptocurrencies?
I don't know if it's necessary, but I think it is necessary for the states because it also confirms their interest and their support for the very principle of cryptocurrency. Now, in this context, it does not prevent other possible parallel cryptocurrencies that can be exchanged with these digital currencies by the central banks. So I think it's a very encouraging phenomenon as long as it leaves the framework for other digital currencies to trade.
Some experts believe that the central bank digital currencies can pose risk related to data privacy or cyber attacks. Are you concerned?
The advantage of blockchain technology is that it allows for the decentralization of this data and therefore a risk of attack that is much more difficult to put in place. Moreover, it is important to understand that there is also the whole question of digital identity, and I think that the big challenge of central bank money will be to respect the freedoms of citizens through their digital identity on the information that can or cannot be shared. And I think that this is a debate that will have to be held.
Let's say citizens start withdrawing a lot of money from banks to buy central bank digital currencies. Isn't there a risk that this will affect the bank's ability to lend?
No, I don't think so, because if you look at the collapse of Silicon Valley Bank and Signature Bank in the United States today and systematic risk that it posed, there is a problem in the banking sector that has nothing to do with cryptocurrencies. It is a very structural liquidity problem, and that's precisely the concern. When you look at the principle of cryptocurrencies, it doesn't pose a problem for banks. It's an alternative investment of assets with high potential growth if the investment choices are adequate, which can precisely help to restore or resolve a certain number of banking crisis phenomena. If you look again at the United States, Fidelity Bank, which is one of the largest pension funds in the world, has opened up access to the purchase of Bitcoin and Ethereum on their platform to all their clients. So there is an understanding also that there is going to be the need to inject liquidity back into the market. Cryptocurrencies in the context of an African context, where hoarding is quite high, are an opportunity to bring the informal economy into the digital economy and to provide a large amount of liquidity with the savings that will be identified and could be used to be invested in projects to which the population has not been exposed until now. With the introduction of mobile money and everything digital, Africa is making a forward move.
You mentioned mobile money, and I would like to wrap up on that. Financial inclusion, which was struggling to take off, has made a considerable leap with the arrival of mobile money. Can mobile money be the business model to meet the needs of unbanked population?
This is already the case. You have to understand that today M-Pesa transaction flow is 35% of Kenya's GDP. Okay, there's a very simple reality that mobile phones have brought, and that is this flexibility and this lack of need for banking infrastructure. You have to go 10 kilometers to find a bank. You are already in a rural area, which was not acceptable. Today, technology and mobile money in particular even allow you to borrow credit, to borrow a bit of more money. So the revolution we are witnessing, the mobile revolution plus internet, plus even digital activities, which are becoming like a salvation to Africa. And this is what makes it very interesting. So I welcome the fact that the media is starting to take a real interest on this issue, but also that politicians are starting to follow suit. Imagine that we have 50% of gold reserves, 70% of diamond reserves. We are going to have to do something about it.
Mr. Touré, thanks for joining us.
You're welcome.
Now let's take a short break. Stay with us on Africanews. Welcome if you're just joining us. Report by the DRC General Inspectorate of Finance on the contract signed in 2008 between the government and the Chinese companies has a damning effect on the Congolese people. 76 billion in earnings for China against 3 billion in infrastructure for the DRC. President Tshisekedi, who intends to revise this contract, denounced the financial theft of his country's natural wealth.
President Felix Tshisekedi has called for a review of the mining contract signed with China by his predecessor Joseph Kabila to guarantee the interest of the Democratic Republic of Congo. In 2008, former President Kabila negotiated a contract with a Chinese consortium in the form of a barter agreement. Under the terms of the deal, the Chinese side agreed to build infrastructure in exchange for a 68% stake in the Société Sino-Congolaise des Mines, a copper and cobalt mining joint venture with a Congolese state mining company, Jekami. In mid-February, the DRC's General Inspectorate of Finance found that there was a significant financial imbalance in this collaboration agreement to the detriment of the DRC. In its conclusion, the IGF put forward an amount of $76 billion of gain for the Chinese party against $3 billion of infrastructure for the DRC. Beijing, on its part, rejected a study published by the IGF denouncing a report that does not correspond to reality. While China has announced the disbursement of $500 million for infrastructure project, Tshisekedi has reportedly asked his cabinet to bring together all stakeholders to prepare for discussions with Chinese partners, according to the Congolese government.
Foreign rating agencies should consider mineral wealth as a performance indicator, especially for Africa, which is rich in mineral resources. This is the claim of a group of economists in South Africa.
In light of rating agency S&P Global revising South Africa's credit rating outlook to stable from positive this month, there is a call for the big three agencies made out of Moody's, Fitch and S&P to provide reports that measure the true growth of South Africa's economy and include South Africa's mineral wealth as a performance indicator. an African credit rating expert, says the methodologies used by the big three rating agencies have over the years been contested.
The methodologies have been contested from a number of spheres, but one of the main issues is the fact that they underplay or undermine the growth prospects in Africa. And they also dismiss even the current growth. By current, I mean, in the pre-COVID period when there was a significantly a high growth rate in Africa, they were dismissing it as fragile growth.
Competing with the dominant rating agencies, Sovereign Africa Rating, known as SAR, launched in South Africa last year. The agency says there was a need for an African alternative in the market.
We needed an agency that operated from within the continent to give an opinion that was objective, that was independent and informed by accurate data. However, that is very important for the South African economy to fight fairly and to compete fairly. And in order to do so, it should be measured on objective attributes and not attributes that are based on sentiment.
SAR went against the grain as S&P Global, Fitch Ratings and Moody's placed South Africa's bonds into the sub-investment territory. SAR instead affirms South Africa's long-term sovereign status with a stable outlook.
That's the end of this edition of Business Africa. The news continues on Africanews.com.